Welcome EdTech students to another lecture topic in laboratory management. Today we will be discussing about laboratory budget. This talks about revenues and expenses over a period of time and also deals with the laboratory finances. So be ready with your calculator during examination. In this topic, we will explain budget and budgeting process, distinguish different types of budget, and make a budget proposal properly. To outline my lecture, these are the subtopics. So as you can see, this is just a short discussion. To begin, let us define operational budget and budgeting. Budgeting is the process of planning, forecasting, controlling, and monitoring the financial resources of the organization. It is through budgeting that an organization turns its strategic plans into daily operations. A budget serves as a tool and a benchmark for monitoring the performance of the organization throughout the fiscal year. While operational budgeting is the process of planning for the laboratory as an ongoing business concern, including accounting for everyday needs and expenditures. It represents the financial parameters of the laboratory goals for the coming year. Operational budgeting have several types. Using the capital budget, where the management plans for the acquisition and completion of specific equipment and building projects that require major financial commitments. These types includes forecast or projection, flexible budgeting, and zero-based budgeting. Forecast or projection method budgeting is a budget prepared based on a forecast of what is expected to occur during the next period. This makes projections of the increases or decreases that will occur of each line item in the budget based on historical information and adjustment for anticipated changes such as inflation or nature of the business. While flexible budgeting tries to set expenditures based on a variable workload volume. An example for this is increasing manpower to hospital census increases. And the last is the zero-based budgeting. It is a method that analyzes needs based on prioritizing of goals and objectives and not on past allocations. To prepare a budget, four issues must be addressed in preparing. One is time frame, forecasting stage, second, third is scheduling, and fourth is synthesis of information. Time frame is an annual budget which covers 1 year. This is the main working guidelines for management over a year. While forecasting stage, management must consider the following factors. Shifts in patient mix or volume. This refers to the demographics and the volume population of your patient. Changes in medical staff composition, expansion or cutbacks in services offered by the hospital or the laboratory, and population fluctuations. Scheduling stage, where most institutions start the process about 6 months before the beginning of a new budget year. And the last factor is synthesis of information. This tells how the financial information is organized and is very important in budget preparation. After preparing the budget, management should review the process. And there are three methods of obtaining future budgeting figures based on revenue or volume projections. Number one is using the actual cost. This refers to the actual expenditure, including market price, delivery, and setup price. Ratios. This is the total expense divided by the total income. And the percentage calculations, allocating parts of your income to your operational expenses for the coming months. And a pro forma budget is a budget based on the extrapolation of historical data. This calculation projects the income and outflow for the incoming months. To make a budget, management should observe the following techniques. Number one is to develop a prediction of future volume or workload. And ratio can be calculated between the cost item and revenue or volume using the supply expense or test formula. Supply expense or test is equals to the current supply expense divided by the number of laboratory tests performed. And some budget items have predetermined costs like instrument leases and service agreements. And expense items can be compared to the revenues of the department and a percentage calculated to project future relationships. For example, the cost of supplies may represent 17% of the revenues of the laboratory. This can be used to project cost in the coming budget year. Much attention is given to the achievement of budget goals, and comparing actual results with budget projections is an important method of control. Thus, monitoring and feedback is essential in budgeting. The capital budgeting is the process used by organizations to plan, evaluate, and choose between future investment opportunities. This is the mechanisms whereby the laboratory selects and authorizes the purchase of major equipment and building projects. The capital budgeting process involves 5 steps. Number 1, identifying investment opportunities in the form of a new business line to product expansion to purchasing a new asset. Number 2, evaluating investment proposals by identifying different options. Like once decided that new product or services will be added, the next thing that you should decide is how you will acquire the product or market the services. Number 3, choosing a profitable investment by ranking the options as per returns and select the best option available. Number 4 is capital budgeting and apportionment by identifying the sources of funds and allocating it accordingly. And the last step, or the number 5, is performance review or reviewing the investment by comparing the investment expected performance to the actual performance. And there are 4 issues that must be addressed in preparing a capital budget. These are capital item, time criteria, price criteria, and purpose criteria. Speaking of capital item, example of these are building project, piece of equipment, or instrument that meet specific institutional and regulatory guidelines of time, price, and purpose. And usually, time frame is 1 year or within a year, while a time criteria if a product provides service for more than 1 year. Price criteria represents the characteristics of customer or a deal. Example of this is a new heating block costing 500,000 pesos that would meet the other 2 criteria for capital items, but because of the low cost and the paperwork requirements, it would probably be handled as a supply expense for the year of purchase. While purpose criteria refers to where the budget is intended for. For example, entirely new instruments, furnitures, or building projects are normally classified as capital projects under several tax rules. If it is a repair or a replacement of part of existing equipment or structure, it is included in the operational budget. Capital budgets are divided into 2 parts according to the amount of expenditure. Projects costing less than a set limit need minimal paperwork, And whereas those above this amount require extensive, in-depth analysis. Thus, a low-cost project need not require extensive market study. While CON, or Certificate of Need, is a document issued by a government regulatory body to authorize a capital project. This was established in an attempt to control spiraling medical costs and to avoid duplication of services and the overbuilding of hospital beds. Also, project capital proposal is needed to evaluate capital expenditure, and there are two types of analysis that you can use. One is narrative and the other is quantitative. When using a narrative tools, you can justify or use justification, prioritization, or opportunity cost. In justification, the manager must explain why the project is needed, how it will benefit the laboratory, and why it should be considered over competing projects. Proposals can be justified by being grouped into one of the four categories. Number one category, is it necessary to maintain present service levels? Number two, will it provide significant savings over current methods? Number three, or will it enhance or improve current programs? And number four, will it offer new procedures or services? So the more information the manager can provide to support a proposal, the better chance of success. Statistics that demonstrate potential in cash flow or physician-to-patient satisfaction enhance the presentation. So increases in testing volume, reduction in reagent cost, and faster turnaround time are also factors in considering the project. While prioritization is giving relative importance or urgency of the project, and opportunity cost is the value of what is given up in order to pursue another project. Or you can use a quantitative tool in evaluating, such as the computation of the payback period. Payback period refers to the length of time it will take to recover the cash outlays for a project. This is the simplest method for calculating return of an investment. So, to solve for the payback period, you will use payback period is equals to P over I, where P is equals to the purchase price of the project and I is equals to the annual income generated. So, for example, if your laboratory acquire a new chemistry analyzer that cost 110,000 and will produce an annual income of 380,000, so payback period is equals to 110 divided by 380,000. It will give you 0.29 years times 12 months. So it will give you a 3.5 months. So for your return of investment, you will be having that after 3.5 months of operations. While the ARR, or the average rate of return, is the average yield over the life of an investment. For example, if a chemistry analyzer has a life expectancy of 5 years, the ARR can be determined or solved as follows. ARR is equals to annual income, or I, over purchase price, or P. So, ARR is equals to I over P. Where 380,000 times 110, it will give you 3.45, and times 100 to get the percentage, it is equal to 345%. So you have 345% return of investment after 5 years of using the analyzer. While the NPV, or the net present value, or the time money value, refers to the future value of a dollar compared with today. This means that the dollar amount that it is where investment now at a given rate of return would accumulate to a given specified value, a specified number of years in the future. Similarly, investors expect to be rewarded for their patience by receiving a rate of return on an investment which could be in the form of interest, dividends, or capital gains. So to solve for the time value of money or the net present value, you can use the formula FV is equals to PV times 1 plus K to the N, where FB represents the future value of an investment, PV, its present value, multiplied by 1 plus interest rate, that is K, and to the power of N, where the number of investment periods usually expressed in years. And the internal rate of return or the time adjustment return period, if the net present value or the NPV is the worth of the future earnings at today's rates, the internal rate of return is the ratio of cash flow and cost of capital factors to the amount of investment required. And required rate of return, a bottom line level of income required by a company before any project is considered. If the venture cannot be shown to benefit the company economically in cost savings, efficiency enhancement, or cash flow, it is rejected outright. If a plan involves building or remodeling, the company may either pay with current resources or borrow the needed funds. With laboratory instruments, there are three options available for considerations: outright purchase, leasing, and agent rental plans. If it is outright purchase, this refers to the paying in full in one-time payment. Leasing in terms under which one party agrees to rent property owned by another party, while the agent rental plan is the laboratory is provided with analyzer on the grounds that the laboratory would pay a cost per test to the manufacturer or the distributors of the analyzer. So acquisition options includes operating lease and capital lease. Speaking of operation lease, if the lease can be cancelled at any time without further commitment by the firm, costs are included in the supply part of the operational budget, it is considered as operational. While capital lease, if a lease that cannot be cancelled or includes an option to purchase and included in the capital budget. Also, in budgeting, depreciation should be considered. Depreciation is the monetary value by which assets diminish with time and usage. Example is the salvage value. This is the value of an item at the time of resale, trade-in, or disposal. Or you will have an allowance calculation method, which is the straight line depreciation and the unit of output. The straight line depreciation is a method based on time element of depreciation. As product grows older, its value decreases and maintenance cost increases. So annual depreciation equals to cost of project or salvage value divided by the life expectancy of the machine. While the unit of output or unit depreciation is a method of determining the depreciation allowance based on unit output. This considers the fact that equipment deteriorates based on the rate of use as well as time. So unit depreciation is equals to the purchase price or salvage value divided by estimated number of units produced over the lifetime of the investment. And accelerated depreciation refers, or these are methods followed by regulatory agencies to encourage investment. To common techniques in And there are two common techniques in accelerated depreciation. These are the double declining balance and the sum of year digits, or the SYD. This may benefit the company over short term by increasing costs to offset large profits or reduce the amount of taxes owed in the government. So double declining balance, or DDB, refers to the depreciation rate that is applied doubled or 200 times that of the purchase price, while the sums of year digits, or SYD, are depreciating asset by a depreciation factor unique each year. So in sum of year digits, you are using a depreciation factor and using the asset's total acquisition cost minus or less the asset's salvage value. Thus, a depreciation factor is equals to asset's total acquisition cost minus asset salvage value. So capital budget proposal is a representation that should include the name and type of the project, followed by the narrative justification and the financial year, or the financial analysis. So this is an example of the budget proposal format, where you can see the basic information about the project, and at the bottom you will see the justification why the budget is needed, or the project is needed in your laboratory. And remember that in developing a budget, always be consistent. Make sure your budget and proposal match. Be conservative. Economize when you can. Be careful. Observe for your basic needs as well as health and safety. Use common sense, research skills, and market study to arrive at specific line items. And consider your laboratory capabilities and income. So this is an example of the laboratory operational budget. This shows the number of samples that is being processed and their operational cost. And that ends our discussion. So for further reading, please check these references. And don't forget to answer the activity posted in the classroom work tab of the Google Classroom. Thank you for your attention and keep safe, everyone.